I think what's driving the market higher today is really a technical snapback. You know, the rubber band got pulled really far in one direction. Bob Pisani was on earlier talking about it, but you can look at any number of measures. I mean, last week, 90% of stocks in the S&P 500 made one-month lows. You had 4 days in a row of the put-call ratio in the 95th percentile, so some pretty negative sentiment in the options market. And I actually thought it was fascinating. If you looked at flows into levered ETFs that are betting on the market going down, they were ridiculous. I mean, last Thursday, some 300 million shares purchased. So I think taking all of that in combination, the market was bound to snap back at some point. Yep. And I think that's what we're seeing today. The problem is we're still pricing in uncertainty. It's not even risk. Risk can be calculated, analyzed, probabilities assigned. I think the spectrum of outcomes is so wide here that one trading day is not going to resolve all of our issues. So we're telling our clients just to sit tight for now.
Yeah, and all those people who bought those, 2 and 3 times inverse the market ETFs are getting something handed to them today, and certainly that may be contributing out there. But Burns, I mean, you're a long-term player. I get it. You want to buy low and sell high, or just keep buying low. What are you buying today?
Well, we're really looking at equities in 2 areas because, we are at a point now where the markets can embrace risk. You have 3/4 of the S&P 500 companies yield more than the 10-year Treasury bond. And so there are some rewards for taking risk. And, looking at it in 2 ways, almost a little bit of a barbell approach. The first bucket being look for names that actually, if the health scare does get worse, they're going to hold up a little bit better. Companies with high dividends, companies with stable earnings, and more important than anything, companies with clean balance sheets to allow them to weather the storm. And so, we're looking at some of those names like some of the telecoms, maybe the defense companies. And then on the other side of the coin, there's a lot of really, top-notch, high-quality, industry-leading companies that are now on sale. And so, likewise, look for companies that, you might be able to get good values with these names that are, trading at much steeper discounts to where they were a couple of weeks ago that are going to actually, come out a little bit more strongly on the other side.
Burns, what do you make about the level of rates here? Because it just seems like no matter what's happening in the stock market, if this extremely low period of low rates persists, does that, I mean, how do you interpret that? What is your advice to clients?
I think that, a lot of it's just, supply and demand. The supply of yielding alternatives is very low. At the same time, the demand is very high, and you have money flowing in not just here, but as well from overseas, looking for yield anywhere they can get it, which, again, I would reiterate, probably makes a really strong case for companies that are paying dividends, because whereas the Treasury yield, that's a stable yield versus, you look at U.S. companies, they have dividends that have a track record for growing faster than the rate of inflation. So that's one of the things we're really, stressing to our clients and looking for in our portfolio, or those dividend growers are probably a great place to be in this type of market.